Hey, everybody. Thanks for joining us and welcome to my home here in Boulder, Colorado. Really appreciate having you as a member of the Akras Insiders community. And thank you for joining us for this goal setting webinar focused on 2021 and also achieving passive income through calculating your freedom number. My name is Charlie Stevenson. I'm one of the founders of Akras Capital. I'm one of the three founding partners, which includes Linying Zhou out in Boston, Massachusetts, and Christina Knight, who also lives here in Boulder. She's also my wife. And just a little bit about Akras. We started Akras to produce freedom in the lives of our partners so we could travel the world and spend more time with our families several years ago. The company was actually founded as we traveled through Asia, primarily backpacking around. And during that time, we were renting our home in Boston and generating passive income. We kind of realized that this was a freedom to allow us to continue to travel and live life on our terms. So we chose to build this into an actual business. And after testing out this model and actually creating some freedom for ourselves and our partners, we chose to begin bringing that same freedom to others who we knew in our immediate network. And now we've grown it into a larger network of investors. Our goal, and my goal for today's conversation, is for you to walk away with some tangible and action-oriented strategies for goal planning and goal achievement this year, which is an important distinction. And further, for you to begin calculating your freedom number, which we'll talk more about, and learn about the different strategies that you can employ to achieve it. I'm going to take about 15 minutes to talk about goal setting and this technique that we use that works really well. I'm going to take 10 minutes to share the basics of calculating your freedom number and how you can use that to achieve your goals that bear financial costs. Hold questions and your applause until the end, and we'll have plenty of time to answer those questions to dive deeper. The last 20 to 30 minutes is reserved for Q&A and diving deeper into these different topics. So overall goal setting techniques and strategies. So one thing that I would like to just mention is that people typically set goals in all sorts of different ways. The way that I used to set goals was very kind of rudimentary and simple, and I think it's reflective of the way a lot of people learn to set goals. I'll take an example from a couple of years back it's changed a lot since we've studied and implemented some of these new techniques, and I'll share that with you. But for me, the way I used to set goals was something like, this year, I really want to get into meditation. I want to have a meditation teacher. And this was actually a goal of mine back in 2019. And that goal was a nice idea. Having a meditation teacher and deepening your practice is really great for so many things. And it would generate a lot for me in my life and my family. But the likely almost certain future with a goal like that is that typically without different things put in place, it won't happen. So my goal was to find a meditation teacher and deepen my meditation practice. That was my goal in total. And life got in the way. I wasn't able to find one. I didn't create one. So did I find a meditation teacher in 2019 that year? No, I didn't. So ultimately that goal was a nice idea, but it wasn't achieved. So a lot of people have similar goal setting strategies. It might be like, oh, I want to lose 20 pounds. I want to, be lighter. I want to have more physical fitness. And so we study goal setting a bit and came up with, well, we didn't necessarily come up with it, but we looked at a lot of different people that have been goal setting, and we synthesized these different ideas and came up with a better goal setting technique that's essentially 5 steps. And I'll share that with you now. The first step is really to pick an area of your life that's important to you, or multiple, but starting with just one because you don't want to bite off more than you can chew. The second step is determining the overall outcome that you want to have related to that area of your life, and doing something called visioning. And we're going to dive deeper into each of these in a minute. The third is setting specific SMART goals and objectives that move you closer to achieving that outcome. The fourth is laying them out on a calendar of milestones that's just very obviously laid out. And then the fifth piece, which is really important, is getting an accountability buddy and sharing your goals and your outcomes with the world. So diving into these a little bit further. So the first one was picking a single area of your life that you want to elevate and focus on. I'm going to use my mom as an example. Family is really important to me. We spend a lot of time with my mother, my whole family. Family is probably one of the top commitments I have in my life. So I'm gonna use my mom as an example, and some of the goal setting she's done. So last year, our family, during a family goal setting exercise we did together, she picked the area of family as her main focus. So we're gonna use that as an example as we go through these 5 steps. When I personally am goal setting, I have about 7 different areas of my life that I focus on. And it's important to just start small, but as you get more advanced with this technique, you can pick many areas of your life. So these different areas can include family and your spouse, your physical health, your mental health, your spiritual health, or intellectual personal growth, whatever you want to call that, financial health, adventures and lifestyle, and then community and friends. So this is the 7 buckets that I have. I call them gardens, but neither here nor there. So picking that area is the first step. So we're going to use my mom's example of family. The second step is doing a quick visioning exercise to determine an outcome. So great, family is what you want to focus on and elevate. Awesome. But specifically standing on January 1st of 2021, in this case, my mom's goal setting back a year ago, what did she want to have in that area of her life of family? What does life look and feel like when she's chosen family to elevate and goal set around it? So I pushed her a little bit. I said, what do you really want to have a sense of connection? What do you really want to have with family? And she wanted to have a sense of connection and love present in the family. Especially my father passed away a couple of years ago, so there was a little bit of a missing there. And so she wanted to have that present within our family again. So standing on, the end of the year, thinking about what she wanted to have around family, she's like, I want to have more love and connection present. So there you go. Now you've got an outcome specific to your goal. That's really what you want to have and feel at the end of the year. So the next step is moving on to setting goals that lead to that outcome. And there's a really great technique for this. And you may have heard of this before, but it's called SMART goal setting. And this SMART is actually an acronym that stands for specific, measurable, achievable, relevant, and timely. So essentially, you want to find the different milestones or the specific goals that lead to that outcome and make sure that they have these characteristics of specificity, measurability, achievability, relevance, and timeliness. Now, they're relevant and timely because you're goal setting for the year. It's important to you, so you can just all of a sudden check those 2 off. So the 3 that are left are specific, measurable, and achievable. So if you don't break complex goals down into simple bite-sized pieces, they can immediately feel overwhelming, and you're already at a disadvantage from the beginning. There's a lot of really amazing books out there like Atomic Habits that talk a lot about this, but breaking down goals into smart bite-sized pieces is the best way to do it. So, okay, with SMART, how does this apply to what my mom was trying to do and creating, a focus on family with having love and connection present? So she knows that when our family gets together on vacations and to do things together, that's when that fun, connection is present. That's when we're all having a good time. And that's what she really loves, that feeling of us all getting together and spending time together. It's fun. It's undistracted. So going up to the lake together or going on an international vacation or something like this, she knows creates that. So there's one potential milestone or goal that can lead to the outcome. So the other thing, so what she chose to do was let's plan 2 family vacations. Those are 2 goals that will lead to the outcome. They're achievable, they're measurable, there's a lot of, they match the SMART characteristics. She also wanted to do a family weekly call so we could stay in touch, and knew that was going to require some technology that we could use to do that. So all of a sudden now you have a bunch of tangible things that you can do and that my mom could do to create that outcome that she could then put over kind of on a calendar, overlay on a calendar, and work to achieve over the course of the year. So this is all, very obvious, but if you don't break it out this way, it can seem really overwhelming. So that's the point of all this. So the next step is putting those actions on a calendar with monthly milestones. So it's easiest to break up a year into chunks. So we typically choose 3-month quarterly blocks. It works out for, businesses to do it that way. And when you set it out that way, it doesn't feel quite so unachievable. So with her, she put, planning the summer trip for the first 3 months, planning the other spring trip for the next 3 months, or actually reverse those. And then she added putting some other, outcomes in place over the course of that year. And the final really important step is, after you've laid your milestones out on the calendar, is finding an accountability buddy, someone who can keep you accountable to achieving those goals and those milestones. This can be a family member, it can be a friend, your spouse, a business colleague, someone who checks in with you at least on a weekly basis via text or phone and says, hey, how's it going? Like, where are you on your goals? Where are you on your milestones? Are you moving towards your eventual outcome? And this is a really critical part of this whole technique, because when you then put the onus on someone else to hold you accountable, it creates a structure. The last part about accountability, and this is kind of the fun part, is telling the whole world about your outcome and your goals. Because once you start telling your family and your friends and your network and your community about it, it starts to immediately become real and something tangible, not just a thought or an idea in your mind, but something that is going to start happening the moment you start speaking about it. Even if you haven't taken a single tangible action on it yet, this is one of the most important steps to do. So sharing with the world. The other benefit is you're creating public accountability and in this accountability structure as well. And so people are going to ask you once in a while, oh, so how's the family focus going? Did you get that trip planned? Are you going to be going this way or going that way? And that way you've got a bigger structure around you of people that are just kind of cheering you on. So that's essentially the technique and the structure. And your homework is to pick those areas of your life that you want to focus on. So maybe it's family, maybe it's health, maybe it's financial freedom or financial health. Pick one of them or two of them. Set your outcome, sit and say, on the end of the year, on the first day of the next year, what do I want to have in that world? What are the actual goals and milestones that are going to be required to achieve that outcome that are SMART? So simple, measurable, achievable. They're obviously realistic and timely, or at least relevant and timely. And then find that accountability partner and begin putting them into place and lay it out on a calendar, maybe a quarterly calendar, and start working towards achieving them in bite-sized pieces. And then tell the world about it. Tell everybody you know. So that's essentially the technique that we use for goal setting, and it's really successful. I mean, you end up setting some big goals, parts of it you achieve, parts of it you don't, but ultimately, directionally, you end up achieving the outcome that you desired, or you learn a lot about what it takes to achieve that outcome. So it's can be a little bit iterative. Okay, so moving beyond the goal setting exercise and into really the freedom number exercise, which is highly related, because the reason we started Akras was to produce freedom in our lives and our partners' lives, and ultimately the lives of our investors and the people that partner with us. And freedom can be defined in a lot of different ways. We're defining it specifically as the freedom to do what you want to do when you want to do it. And a lot of times that's a function of having access to resources, time resources, and monetary resources. So your freedom number, which is a really critical distinction to make when you're beginning your investment journey, and identifying and calculating your freedom number, it's defined as the amount of money you need to passively earn to totally cover your costs of living, which includes the goals that you set. So that's how these two things tie in. So if you had passive income, meaning income that's generated by different areas or different strategies that require very little work of your own. This is different than a W-2 job. This is something like a stock or a bond or a real estate investment that's providing you with passive income on a monthly or quarterly basis. So if you had enough of that being generated to cover all of your expenses in your life, you would be free to do whatever you like, essentially. That's the idea of the freedom number. You could use that time to travel, spend time with family, focus on something you're passionate about, focus on the world, your community, learn an instrument, whatever you like. So all of a sudden, when your costs are covered passively, you have total freedom to focus on what it is that you want to do. So that's essentially what the freedom number is. And we're going to talk briefly about how to calculate it. I'll give you some homework as well. And let's talk about how this ties into costs. So goals have costs as well. Not all of them, but many of them do. Take my mom's goal of family togetherness, for example, and bringing the family closer. So taking our close family of 7 on a vacation has costs. She wanted to take us on 2 vacations, one to the lake and then some kind of international vacation, which was so generous of her. But it has costs. And Also figuring out the technology that she wanted to use to bring our family together, which ended up being like essentially like a Facebook portal, which is kind of like an iPad specifically for family connecting, also bears costs. So once you have the costs of that goal, which she figured was going to be about $10,000, essentially that gets added on to all of your normal daily costs, and that becomes your new freedom number. So breaking it down into the costs is this important step. So I'm going to do a quick overview of calculating a freedom number so you can achieve your goals and that bear the financial costs. And you can take this exercise away from this call and do it on your own at home. It's a lot. Sometimes there's a lot of sitting down and writing things out and looking at your bank statements and figuring it out, all the different costs of this. So it doesn't make sense to try to figure it all out right now. But for the sake of an example, I'll continue to use my mom. So for her, her freedom number is made up of many costs. So she has her townhome, which she lives in Sun Valley, Idaho, which has a mortgage and it has utilities. So there's line item number one, your accommodation. That's usually your largest expense. Line item number two would be utilities. What do you pay for your internet and your electricity and your water and garbage and all that kind of stuff? She has an HOA, so there's a cost there. Her car, like how much does that cost? She has a Subaru. It requires monthly payments. So that's your next item. Her healthcare. Other items are groceries, subscriptions to Netflix and Spotify, and monthly subscriptions that she has for magazines or whatever. By the way, that's a really great place to lower your ultimate freedom number. You can cut small costs out, and if you can lower your freedom number, then it makes it more achievable, of course. So she also has an entertainment budget, and she has a travel budget and a family budget. So all of these different things, if you put it out onto a Google sheet or a spreadsheet, are going to look about like 15 or 20 items. You just sum all those up, figure out, on a monthly basis is critical too. So divide it by 12. If it's like a yearly cost, divide it by 12. And then you've got your monthly freedom number. For her, it ends up being around, let's say $5,000 a month for this example. And so this is now her freedom number. So $5,000 a month is what she needs to cover with passive income so she can be totally free, be retired to focus on what she loves, which is botany, spending time with family, traveling, and that kind of thing. So moving beyond that into what passive income is, she has the passive income established to have achieved her freedom number. She's really lucky and privileged to have made that jump. And the way that she does that is with a variety of passive income generating investments. So she has dividends from stocks and bonds. And she also invests, she also has her savings account, which has interest that accumulates and accrues. So she makes money that way. And she also invests in multifamily real estate. All of these things pay her passive income on a monthly or quarterly basis. And all of that amounts to $5,000 at least or more. So she has achieved her freedom number. So now when she looked at this goal of family connection, it bears new costs above and beyond her current freedom number, which she had calculated. Like I said, she figured out it was going to be about $10,000 per month to take the family on 2 vacations and to connect us with the Facebook portals. And when you take that $10,000 and divide it by 12, it ends up being a little more than $800 a month. So that number needed to be added to her overall freedom number, her overall expenditure. And she needed to then figure out how she could realize more passive income to achieve it. So she had to figure out how she could deploy some more capital that she had, either from a savings account or refinance her townhome or whatever it might be, to create more capital to then deploy into investments that she already is familiar with, so that she could then cover those costs. So essentially, that's your homework. Go and calculate your freedom number, add the costs of your goals to that freedom number, and then figure out what you need to do to create passive income. And sometimes if you just wanted to focus on, achieving your goals, you could start there. Instead of trying to figure out all of your costs and covering it all with passive income, say you did this goal setting exercise and you said, okay, my goal for the year is going to cost me about, let's say $10,000, just like my mother. You now know that you need to generate about $800 per month or $800 to $900 per month in passive income to achieve that goal and not have it affect any of your other finances. So that's when you start looking for passive income generating investments that then would produce that $800. And you can kind of back into the total amount of capital that you need to deploy or investment money that you need to invest. in order to generate that $800 to $900 per month. And that's kind of where Akras comes in, especially with our multifamily investments. And that's where we make ourselves available to talk about how multifamily investments can help to generate that amount of money, that passive income, which make myself available to talk to you about at any time after this. We can also talk about it in the Q&A session. So, and that's about where we are now. I'm going to open this up for questions and open discussion about anything here, about goal setting and this technique, about passive income and calculating your freedom number and how to go about doing that, or just talk about real estate or other ways to passively income, or I can talk to you about Boulder and living here. Whatever you want, we've got some time to do that. So thanks for your attention so far. Thanks for your patience listening to me talk and talk. And I hope that some of these techniques and ideas can inspire you to have a super strong 2021 and do some goal setting and achieve those goals more importantly than anything else. So thanks, and let's open it up. All right, I'll ask everybody to unmute that has questions. You can also put questions into the chat box, but yeah.
So Charlie, it's kind of a question, and maybe you'll help me formulate this, but kind of where I'm coming from is, so I'm 26. So I'm not necessarily looking to like hit a number and just like call it quit on everything. I'd get bored by March. Kind of what I'm looking more to do is like essentially grow my investments to the point where later in life, say I'm in my 30s or 40s and have kids and want more time with them, then I can really kind of like lean more heavily on the passive income.
Right.
So I don't know, could you kind of talk me through what you might recommend there? Because, you know, for me, my goal isn't necessarily to get a nest egg right now. It's kind of to like work towards that.
Totally.
So that
Yeah,
down
that's
the
a good
road.
question. Yeah, that's a good question. So, I mean, how do you get started? Certainly, I kind of lumped everything together into coming up with your total freedom number, which would set you free to like leave your job or start a new passion project or something like that. But ultimately, that's sort of the end goal that many people have, you know, especially when you're in your 20s, 30s, 40s, and kind of in the prime of your career. You're not interested in quitting your job. You're not interested in, you know, being, you know, totally free to just go off and travel and that kind of thing. You'd rather just start creating passive income to blend into your active income so that you're just beginning that journey earlier and essentially getting confidence in your financial freedom so that eventually you can have that. So how do you get started? And this is the case with most people that invest with Akras. This is the case with myself and my wife and Lin Ying, our other partner as well. When we got started, we did not have the capital to deploy into all the investments we needed to instantly achieve our freedom number. We said, all right, this is going to be a multi-year process to get to our freedom number. We're going to need to start with achieving, you know, 10% of it or 20% of it or 30% of it. And so ultimately it's about just getting started and not getting overwhelmed by, oh my gosh, my total monthly expenditure for myself and my family is $10,000. I need to generate $10,000 in passive income right away in order to be free. No, it's just not like, unless you have a huge trust fund or a huge amount of capital deploy, it's unlikely that that's the situation that you'll be in. So getting started is important. So what I recommend to most people that are just getting going is start small. Start with one investment. Start with deploying kind of the minimum, maybe the minimum or a little more than the minimum in most investments that most syndication operators in multifamily or even starting in stocks and bonds and figuring out how all this works. How do you begin generating and deploying capital? Because essentially, if you just get started, that's going to start creating momentum for you to move forward. So we'll talk about multifamily because that's Akras's main focus. So what I would recommend is start with, you know, earmarking $50,000 of your capital, whether it's savings or capital that you find from other places, and earmarking that to deploy into an investment deal. Use that first foray into investment as an opportunity to educate yourself about how all this works. It looks like talking to folks like us, talking to other operators, asking them a lot of questions about how multifamily syndications work, asking a lot of questions about what a multifamily is first of all, and getting comfortable with that whole process and that whole asset class, making sure that it suits your risk appetite. Make sure that it suits your timeline and your liquidity, meaning how much time do you want to put this money in? So answering questions like, okay, if I was to take $50,000 from my savings or take $50,000 after refinancing my home, like what's my need for that capital? Do I need it to pay for groceries and my kids, different costs? Then if those are the answers and you don't have that money to safely invest, then you should work on building more income and building more wealth before you can do that. But once you have that comfort level, and once you have that money to deploy without risking, having any financial repercussions, if that money was to be lost, then you can start, thinking about investing. We like multifamily because it is very safe and the likelihood of total loss is very, very low. And that's part of the reason why multifamily was our choice for a investment asset. So anyway, long story short, it was a good question, Chris. You want to start small, start talking to operators like us, earmark $50,000, which is the typical minimum investment amount, and begin researching and figuring out how to invest that, and wait for the next deal to become available to deploy it. I don't know if you have a question about searching for where to find that $50,000, because that can sometimes be the necessary first step before you actually begin looking for the operator. But does that answer your question?
Yeah, that definitely helps, because I've been getting going on it for a while, and I've tried different, investment accounts, 401ks, IRAs, just like, put money in the stock market or index funds. But at least with that stuff, I always just feel like I'm shooting from the hip. The little bit I know about how to analyze a company or, a stock or even an index just feels so like, throw my money into a pond and hope for the best.
Right.
So,
yeah.
and I'm not even that like type A, but I still can't help but like checking it all the time. And it frustrates me that something could just evaporate based on a tweet. And so, I don't know if you want to get more into the multifamily stuff and how you decided that was a better place to go for better returns and more kind of safety than, index funds or just stocks in general.
Yeah, it's a good point. And certainly investing in stocks and bonds and those types of vehicles can be overwhelming to the average investor. You have to trust a lot in the system. You have to trust a lot in your understanding of price earnings ratios and understanding how the market's working and looking at the overall trend of the different indices to see, well, is the economy healthy or is it not healthy? It's really hard to tell these days. And this is part of the reason why we particularly like multifamily investing. Not that we don't have a lot of experience with understanding the other different alternatives for investment. Christina and Linying, our partners, are chartered financial analysts, which means that they went through a lot of schooling to understand how to analyze markets, how to understand different securities for investment. And they worked at the institutional level, investing institutions' funds into these types of bonds and stocks and mutual funds and different types of vehicles like that. And so they have a lot of understanding of that. And that was part of the reason why we said, let's get out of Dodge and invest in multifamily, because these days it's not the same stock market. It's not the same economy as it was of my parents and my grandparents. There's a lot less predictability. There's a lot less psychology. There's a lot more psychology in and kind of energy and emotion in today's market. And that creates a lot of volatility. That's why you see, every day, like you said, Chris, based upon a tweet or a idea put forth by the government, the stock market will either soar or crash. And that sort of up and down volatility is frankly scary. And when you're not a chartered financial analyst or a day trader or someone in the finance industry, how do you really know what company to choose that's going to perform, what mutual fund to choose that's going to perform, that you're not going to lose everything, it's going to evaporate overnight because somebody tweeted something that scared the world markets? So this is the difference between stock market and bond investing and multifamily. So multifamily and real estate in general is a bit different. It's different because it is a highly necessary commodity, essentially. Human beings need food, we need water, and we need shelter. Shelter is something that's always going to have a need. And multifamily apartment buildings, especially, are kind of that type of accommodation that's right in the middle. It doesn't have bear the expense of a single family home. And it is a alternative and an increasingly attractive alternative for our American population. So more and more people are moving into apartment buildings. More and more people are choosing to rent over buy. And so for that reason, apartment buildings tend to be really, really stable in terms of their value, especially when you buy them in markets that are stable, that have really strong economies, that are diverse, economies that are less impacted by things like COVID or changes in disposable income, like vacation types of markets that are really diverse, are really important to focus on. And so multifamily are really stable. They tend to increase in value over time, and there's almost always a need for multifamily apartments in most markets, and especially in stable markets. And so that means the likelihood of investing in something like this and losing your money is highly mitigated by the demand for that type of that type of product, essentially. The other thing is that different than a stock or a bond, a piece of real estate is collateralized, meaning it is backed up by an actual physical, tangible piece of land. It is backed up by a physical, actual building that you can go and touch and see and feel. When you invest in the stock market in, say, Tesla, for example, you're buying a share of a company, which is a tiny piece of ownership of a company that, yeah, certainly has its own set of tangible things, but it's not the same as owning a piece of land, which is what you are when you are a owner of an investor in a multifamily property. So the land is always there. So it's collateralized. It's got something that you can always rest upon. There's always value in that land. So that's another thing about multifamily that we really like, is that it's stable, it's collateralized, and it is very predictable relative to the stock market. Now, because of that, you can make a lot of money in tech or in startups in the stock market, and growth ventures, and you can have really outsized returns, and it can be really exciting. Investing in something like Bitcoin can be really exciting. Multifamily tends to be kind of the slow and steady wins the race. It's not as glamorous, it's not as exciting, but it wins in the end. And that's why we chose it. And that's why, chartered financial analysts who spent their careers trading these types of vehicles on Wall Street are now selecting multifamily as the best way to generate wealth and passive income. So that's a little bit about the different types of assets that you can choose to invest in, and why we choose multifamily for ourselves personally, and why we recommend that to other folks as well. Does that answer your question, Chris?
Yeah, it definitely does. And I guess a slight, maybe quick follow-up to that. What would you, over, 5, 10, 15, 20 years, what would you kind of view as like a balanced allocation of maybe even your own personal finances into, okay, now am I going to go all in with all of my savings into multifamily, or, am I going to take the big chunk and go there but still put some in an index fund or something like that, just to kind of diversify? What do you, what would you see for yourself as like a kind of a balanced target towards?
Yeah, and that's another really good question. So kind of a cliche statement or phrase that you hear when people are talking about investing broadly is the importance of diversifying your portfolio. You've probably heard this before. It's almost cliche. Diversification is really important because regardless of what you're investing in, you want to have, your money out of, you don't want to have all your money proverbially in one, basket, all your eggs in one basket. And so we always recommend, if you're going to be using investment and passive income as a long-term strategy for supporting your life and your family and freedom, certainly having your money spread across different types of assets and in different buckets is really important. So that way, if one does really well, great, and one does poorly, it might end up balancing out. Or if you have some that are underperforming, generally, if you've got a few buckets where you've deployed capital and you've invested, several of them will be working really well and one might not be. So you'll end up having overall a more kind of balanced return, and there's a lot of safety in that. So with us, we actually moved a lot of our own personal capital out of the stock market, out of our IRAs, and into multifamily and other different types of real estate investments. we have our money invested in several different types of multifamily properties, as well as other types of real estate developments. And so, and the other thing I'll say is we do a mixture of investing in equity types of deals, meaning we own a piece of that actual property and the overall return that's generated at the end. And we also invest in debt types of deals, where we are a lender and have a lien position, which is a place where you stand in order of if everything was to go terribly and that particular development was to fall apart and bankruptcy was going to be declared, you have a higher position in the structure so that you get paid before others do. So that's what a debt position is. And so we will lend to certain particular investors and operators our money with a debt position. So having a mixture of equity and debt is a really nice way to diversify your capital deployment, your investments. Debt tends to be better secured because you also have that lien position. It's less risky. Equity stakes in the world of real estate investment bear a little bit more risk because you can lose everything, but it's still very unlikely especially when it comes to multifamily real estate investing. So there's all sorts of methodologies out there about should you have 50% in stocks, 20% in bonds, 15% in real estate. Like there's blends that many economists and many investment professionals will recommend. I cannot, in good faith, recommend the exact blend for you. That's really dependent upon you and as an investor, your risk appetite. Are you a risky kind of a person and you're willing to bet a bunch of money on development, or are you less risky and you want to just invest in debt? Are you going to invest in just government bonds or treasuries, which are some of the least risky investments? Or are you willing to throw your money into Bitcoin or something like Tesla, which is launching stratospherically in the indices, but in the stock market, but who knows where it's going to go? So it really is a question for you to kind of look inward and say, how comfortable am I with deploying capital? But ultimately answer your question, Chris, is like, find multiple places that you can deploy your money and put chunks into different places. So that way you are generally diverse. Again, we mostly invest in multifamily. And in that case, if you're just going to invest in multifamily, then choose many different projects across many different markets. So we invest in primarily in Arizona. We like Phoenix and some of its little submarkets and neighborhoods specifically because there's a lot of growth there. People are leaving Los Angeles and moving there. They're leaving other places and moving there. So there's a lot of growth. But we also invest in Florida. We also invest in Texas. We invest in Boston. We invested in Washington State. And that way, as each of these markets moves along and performs, they might perform at different paces and some might underperform. But ultimately, the overall diversification we have across these different markets provides us with a lot of security in those investments. So that's how I would recommend people, if they chose to just go into multifamily and real estate, they should do it. Just pick several markets and several deals to put your money into instead of just going all into one deal in one market, which could be impacted by a natural disaster or something like this. So does that answer your question a little bit more in a fine-tuned way?
Yeah, I think so. So, I mean, that makes intuitive sense of just spread it out.
Spread it out.
Spread it out. But as in, like, you could spread it out within real estate such that pulling it out of like the just stock and bond world wouldn't be totally reckless if you take that same diversification, concept and put it into real estate.
Exactly. Yeah, you just use that same technique and spread it across. Because if you're just investing in stocks and bonds, like a lot of people use mutual funds as the common way to find diversity in their portfolio. And that's a way where you take, you buy one essentially share of a mutual fund, and that is then split into, maybe 10, maybe 500 different companies that are maybe all in one sector, or a balance of companies that are meant to represent the index of S&P 500 or something like that. So that's another way that people, if they choose to invest in traditional stock market vehicles, will choose to diversify is with those mutual funds. So yeah. But do you have any other questions about goal setting, about calculating your freedom number? Have you done that? Have you done that exercise yet? Have you gone through and calculated your freedom number and looked into that, or done any goal setting for 2021?
Very roughly. No, just got back from our honeymoon, so a lot of things have changed. So the the calculus is different now. So we haven't sat down we haven't rested fully to get to that yet.
Yeah, good. And it's definitely a good conversation to have with your partner, your spouse, and to kind of get on the same page, because a lot of people that I know never sit down and talk about these types of things. And it's my wife and I, we go and we do a retreat once a year, and we spend a couple of days in a quiet place. We're actually doing this in a couple of weeks. We're going down to a cabin. A friend of ours has a cabin down on in the mountain range in the Rockies, and we're going to spend a couple of nights, and we're just going to sit and talk about what our dreams are for the year, what our dreams are for the next 3 years, 5 years, 10 years, and really get on the same page about all that kind of thing. And then, based upon some of those conversations, it might create some new goals, and might create some new costs that we need to start thinking about. And that's when we start baking it into our freedom number and saying, okay, well, if we want to, have this in our life, it's going to bear this cost. So let's build that in and start figuring out what do we need to deploy in order to cover that, years ahead. It's kind of like planning for your kids' college education or something like this. So it's a good thing to do. But yeah, anything else I can answer for you, or any other questions?
One more question, and this is kind of more related to specifically the places y'all look and are on the ground.
Sure.
I know you've talked a lot about Phoenix, and y'all have visited there and are looking there. We live in North Carolina. We just got back from Idaho, so we heard a lot when we were out there about just people leaving California, all the different tax laws and just different things being imposed there, where just a lot of money, a lot of people are leaving California. How does that affect the markets that y'all are looking at? And is the people that are leaving California, is that a demographic that would even affect the multifamily apartment building kind of world?
Yeah, that's a good question. And this phenomenon, which when we first started looking at investing in real estate, we kind of put on our analyst hats. And luckily, Christina and Lin Ying, they're financial analysts, and so they're used to looking at large demographic trends, both globally and domestically. And we looked at all the different pressures that 3 or 4 years ago were dynamically affecting and shifting the United States and its population. And the one thing that we saw was something that has now become known as inland growth or in-migration. And essentially what has been happening for many years now is primary coastal cities, like San Francisco is a really common example that people use, or Los Angeles, New York City, Seattle. All these cities, as you've kind of known, are getting more and more expensive. They're getting busier and busier. There's a lot of tech companies that are coming in and creating jobs, and that attracts population. And as people move into those cities, the cost of living goes up. So rent goes up, single family home prices go up. And at the same time, things like traffic get worse. Getting a reservation at a restaurant or finding a trail to hike that isn't totally loaded with people starts to become a problem. And so congestion begins to happen. And so we started noticing that, especially in Seattle and Washington State, where I'm originally from. People in Seattle were getting pretty fed up. They were frustrated by the traffic and all these things and the cost of living. And they looked over the mountains, over the Cascades, at the city that I grew up in, which is called Spokane, Washington, which is where Gonzaga Zags are from, if you follow college basketball. And they said, wow, Spokane's actually also in Washington State. It's got a lot of the same tax benefits. It's drier than Seattle, which is a benefit. It's cheaper by about 6 times. And I can still work remotely. I could even fly from Spokane to Seattle on a daily basis if I wanted to commute for like $75 and still work my job or work remotely. And so we noticed people were leaving Seattle and moving to Spokane, and Spokane was benefiting from this huge tailwind in growth. And that meant that rent was starting to go up a little bit, single family home prices were going up a little bit, population and discretionary spending in that market were going up, and all these things attending positive economic trends were starting to create more value in multifamily real estate. And that's where we first began investing. We bought 3 assets in Spokane, Washington, 2 of which we've sold and 1 is under contract. So we saw a huge appreciation and growth in that market, and we're really happy with those first 3 investments. So we started saying, okay, if we're seeing this in Washington State, where else is this happening? Well, California, as you heard when you were out in Sun Valley, which is full of Californians, they love it there because it's a beautiful place to be, are also leaving in the very same way. places like LA and San Francisco. They're looking for lower cost of life, higher quality of living, and they're looking at places like Denver was a big recipient of this early in-migration from the coasts. Boise, Idaho was, Spokane, and Phoenix has also proven to be one of these places that's benefiting from in-migration from the coasts and especially from Los Angeles. So to answer your question, this in-migration phenomenon is something that has been part of our investment thesis from the very beginning, and we're really encouraged that it's continuing. And COVID-19 has actually accelerated that, that phenomenon, and we're seeing more and more people moving from the coasts inland because of those very same reasons. And they're now able to work more remotely. So why would you pay $3,000 a month for a single bedroom, in LA when you can pay, $1,900 to $2,100 for a huge 2-bedroom, 2-bath in Phoenix and have a similar quality of life and earn the same income you are making working remotely in Los Angeles? So we're seeing this trend really positively impact places like Phoenix and other places like where we invest, like Orlando and Dallas-Fort Worth. So yeah, it's all good. It's just accelerating. This trend is just accelerating. So does that answer your question, Chris?
Yes, absolutely. These people should just come to the East Coast where rent is a tenth of that.
Well, definitely the Southeast, where you are in the Carolinas, is actually a really great market for multifamily real estate investment. And that's actually, there's some markets in that general region that Akras is also actively looking at and have some partnerships in. So, stay tuned because we are actively sourcing deal, especially in South Carolina. So there might be something that's even closer to home that you might have interest in taking a look at with us in coming quarters. Excellent.
Cool. Well, let me know if you're coming this way.
I definitely will. It's likely in the next month or 2 months, something like this. And that goes for any of our investors. If, we're heading out to a particular market where you are, and you see that in the Akras Insider that we send on a monthly basis, feel free to ping us. We'd love to meet up with you and grab a coffee, talk about real estate, talk about life, talk about goal setting. It's our commitment to just be normal, down-to-earth people that you like to spend time with, because those are the types of people that, you trust and build relationships with. So it'd be great to come out and meet with you in the Carolinas and, just talk more about life and investing and figuring out how to live life better, essentially is what we're working to do with Akras. So it'd be great to see you. And that goes for anybody else that's here or listening in or watching this after the recording. We're make ourselves open and available to having conversations like this with you and learn more about what your financial goals are, what your goals in life are, and see if what we do at Akras can be a service to you and to your life and family. So any other questions, Chris? Otherwise, we'll probably just end it off right now. And anything else I can answer for you, though?
Oh, man, that's it. Thanks for letting me pick your brain.
I appreciate
it.
Yeah, thanks for joining, and thanks to everybody else that's listening into this. Really appreciate having you as an Akras Insider and a member of our community here. And again, my name is Charlie with Akras Capital. If you want to reach out, there are lots of different ways to do it. You can go to our website where you can fill out an investor application and tell us a little bit more about who you are and what you're looking to do. We'll get pinged with that and reach out and schedule a call. You can also send me an email directly at my email address, which is cstevenson@akrascapital.com. There's lots of other different ways you can reach out to us. Just visit our website and it'll have all that listed. So thanks so much for joining me here in Boulder in my home. And hope everything goes well for your 2021. You stay safe and healthy and crush some goals this year. Thanks so much, everybody. Appreciate your time.